A balance sheet is a statement of the assets, liabilities, and equity of an organization at a particular point in time. A balance sheet can also be described as a snapshot of an organization's financial condition. A balance sheet is broken up into two sections: assets on the left-hand side and liabilities and equity on the right-hand side. Assets always equal liabilities plus equity. That is, the balance sheet always balances. Assets are the resources owned by the organization. In general, assets are broken down by liquidity into current assets and non-current or long-term assets. Current assets include cash and other assets that are expected to be converted into cash within 1 year. Examples include short-term financial investments, accounts receivable, that is money owed to the firm by its customers, and inventory. Non-current or long-term assets are assets that the organization expects to own for more than 1 year. Examples include the organization's land, buildings, and equipment, also known as fixed assets, and long-term financial investments. Liabilities are the claims against the organization's assets by outside creditors, such as suppliers, employees, financial institutions, and bondholders. On the balance sheet, liabilities are listed in the order in which they will be paid. Current liabilities include liabilities that are expected to be paid within 1 year. Examples are accounts payable, that is money owed to suppliers, accrued salaries and wages payable, that is money owed to employees, and notes payable, that is money owed to banks for short-term loans. Non-current or long-term liabilities represent financing to the organization with maturities of more than 1 year. Examples include bank loans, mortgages, and bonds. Underneath all liabilities, the balance sheet lists the equity of the organization. Equity represents the portion of the assets available to the owners after all liabilities have been paid. The difference between the assets and the liabilities is the equity of the organization. Equity is also known as net assets, net worth, or ownership stake. Equity represents the value of the organization to its owners. Assets always equal liabilities plus equity. That is, the balance sheet always balances. This relationship is called the basic accounting equation. An income statement shows the revenues, expenses, and net income of an organization for a certain period of time. An income statement is also called a statement of operations. Unlike the balance sheet, which is a snapshot of an organization's financial condition at a particular point in time, the income statement tells what happened to an organization over a period of time, such as 1 year. The income statement first presents the revenues earned by an organization. Revenues are monies an organization receives in exchange for the goods and services it provides. Healthcare organizations, for instance, receive large portions of their revenues from providing care to patients. The income statement then presents the expenses incurred by an organization. Expenses are the costs incurred to generate revenues. Examples include salaries and wages, supplies, utilities, and interest expenses. For most healthcare organizations, the single largest expense is the salaries and wages paid to employees. At the bottom, the income statement lists the net income earned by an organization. Net income is the difference between revenues and expenses. Net income is also called profit, excess of revenues over expenses, or bottom line. Budgeting can be defined simply as planning for how much money you have and how it is spent. A budget is a detailed plan, expressed in dollar terms, for how resources will be obtained and how they will be spent during a specific period of time, such as a month, a quarter, or a year. Here is a simple example of a budget for an individual or a family. The budget first lists the sources of projected revenues or income for the individual or family. It then lists the projected expenses, such as rent, utilities, and groceries. At the bottom, the budget lists the difference between projected revenues and projected expenses. The purpose of budgeting for an organization is essentially the same as budgeting for an individual or a family. Managers in an organization use budgets to plan and communicate their expectations for how resources will be obtained and how they will be spent. Budgets are also an important tool for senior managers to establish performance goals and to monitor operations to ensure that those goals are met. The complexity of organizations, especially large organizations, makes the budgeting process difficult and time-consuming. Managers must make several decisions regarding the budgeting process. First, managers must decide how the budgeting process should take place, that is, how the budget should be developed. In the bottom-up approach, budgets are developed first by department or program managers and then aggregated and approved by senior managers. In the top-down approach, budgets are developed by the finance staff and then, after approval by senior management, sent to department and program managers for implementation. Second, managers must decide whether to use the previous budget as a starting point for creating the new budget or start with a clean slate. Under conventional or incremental budgeting, each line in the previous budget is examined and then adjustments are made to reflect changes in circumstances when developing the new budget. Under zero-based budgeting, managers begin with a budget of zero and must justify every line item in the new budget based on the expected volume of services provided. An operating budget is a forecast of the revenues, expenses, and profit expected for a period of time, such as a month, a quarter, or a year. Operating budgets are prepared at multiple levels within an organization. They are prepared for individual departments, service lines, and payers, and then aggregated to the entire organization. The starting point for preparing the operating budget is the volume forecast or statistics budget. The statistics budget includes forecasted measures of workload or activity, such as the number of inpatient days or clinic visits, for each department, program, or unit. Forecasting volume can be challenging. The future volume of a specific service depends on many factors, including population growth, population aging, disease trends, changes in medical practice, internal changes, such as the retirement of key medical staff, and the activities of competitors. Information from the statistics budget is used in preparing the revenue budget. The revenue budget combines volume and reimbursement data to forecast revenues. Revenue forecasts are prepared at many levels, starting with individual services and procedures, which are then summed up to obtain an aggregate revenue estimate for a department, program, or unit. Similar to the revenue budget, the expense budget is a compilation of expense forecasts by department, program, or unit. The expense budget focuses on forecasting the costs that will be incurred in providing services. To forecast expenses, managers distinguish between two types of costs: costs that vary with the volume of services provided, and costs that do not vary with the volume of services provided. Graphically, the two types of costs can be shown as follows. Costs that increase with the number of services provided are shown here. These costs are called variable costs. An example of a variable cost is the cost of clinical supplies needed to provide patient care. Costs that remain the same regardless of how many services are being provided are shown here. These costs are called fixed costs. An example of a fixed cost is the cost of the building, equipment, and staff needed to provide patient care. Adding together variable costs and fixed costs gives us total costs. The operating budget combines the revenue and expense budgets and uses this information to forecast profits. The difference between revenues and expenses is the profit of the department, program, or unit. When expenses exceed revenues, the department, program, or unit incurred a loss. Variance analysis is an examination and interpretation of what was expected to happen, as specified in the budget, with what actually happened. Variance analysis allows managers to answer questions such as, why was our department's actual profit less than what we budgeted? Why did our department earn larger revenues than we budgeted? Why did our department incur higher costs than we budgeted? Variance analysis is an essential part of the budgeting process. Its primary goal is not to assign blame for unfavorable results. Rather, variance analysis aims to uncover the causes of operational problems so that they can be avoided or at least minimized in the future. Actions taken by managers in response to variance analysis have the potential to dramatically improve the operations and financial performance of an organization. Variance analysis involves comparing two amounts, an actual or realized value and a budgeted value. The difference between these two values is what financial managers call the variance. Let's use the following example to conduct simple variance analysis for a community health center. Let's start by computing the profit variance, since profit is the most important single line on the operating budget. The profit variance is computed as the difference between actual profit and budgeted profit. In general, variances are calculated so that positive amounts signify good or desirable results, while negative amounts are bad or undesirable results. In this example, the profit variance equals $585 minus $600, which is equal to negative $15. This means that the center's profit was $15 lower than expected, which is a bad or undesirable result. Let's conduct additional analysis to determine what caused this lower than expected profit. Was the cause a revenue shortfall, cost overruns, or both? Let's take a closer look at the revenue side. The revenue variance is defined as the difference between actual revenues and budgeted revenues. In this example, $2,535 minus $2,400 equals $135. This means that the center's revenues were $135 greater than budgeted. Now let's take a look at the expense side. The expense variance is defined as budgeted expenses minus actual expenses. Note that we had to reverse the calculation here to show that higher than budgeted expenses are bad or undesirable and hence create a negative variance. In this example, $1,800 minus $1,950 equals negative $150. This means that the center's expenses were $150 greater than budgeted. By breaking down the center's profit variance into the revenue and the expense variance, it is readily apparent that the major cause of the center's poor financial performance was that costs were too high.